hot topics. These are those 1099s out there and the requirements that everybody is either talking about or fear there are going to be penalties involved. Number one is broker basis reporting, which came into play in 2011, and it was thought that this type of reporting, the 1099K and independent contractors, that's why they're hot topics, will help to reduce the tax gap. And the tax gap is the difference between what was paid in on time as opposed to what should have been paid by all taxpayers. That's the tax gap there. And it is growing and growing. They haven't come up with a report in a couple of years, but last report was $450 billion. That's a lot of money. So this is one of the things they came up with. And this cost basis reporting is available for what we call covered securities. Covered securities are those securities bought after this took effect, which is January 1, 2011. So, of course, anything prior to 2011 is called non-covered securities. And the reason why it became so important is when people are reporting their capital gains and losses on their personal income tax return, they didn't have the proper information in order to calculate the gain or loss on there. So the IRS felt that they were losing a lot of money. Also, a lot of people have changed from one broker to another, and maybe the broker was angry that they lost the client, and they say, I'm not going to send those records over. I don't care. Now it's a law. The brokers will face severe fines if they don't report on what's called a transfer statement. And this is all under Section 6045 of the code. And what they did is they had a series of dates. The first one was January 1, 2011, to account for all stocks, followed by rules for, in 2012, for mutual funds and the ETFs, dividend reinvestment plans. That can be a nightmare if you don't know the correct amount. Followed by, they skipped a year, they went to January 1 of 2014 to account for all option trading. Well, years ago when you would get a statement from the broker, it would say at the bottom, these transactions are not being reported to the IRS. Well, since they weren't reported, a lot of people didn't put them on their tax forms, but they were taxable. Now they all are being reported to the IRS. Also, there is an indication on the 1099B for what are wash sales. And the wash sale are those transactions occurring when an investment is sold at a loss, and then the investor repurchases basically the same investment within a 61-day period, which is extending from 30 days prior to taking the loss until 30 days after. Those losses from the wash sales are therefore not deductible, but what happens is you add them to the basis or the cost of the new investment, and then you'll take the loss when you sell that investment. And this is, again, to help us with the tax gap. So we're talking about cost basis, which is the cost of that security, and it determines whether you have this capital gain or loss. This is going to be on your Schedule D of your tax return. But you know, when we have a new law, we're also going to have new forms and new rules. First of all, let's look at this. This is what a 1099-B looks like. And on here, all of a sudden, we're going to have to give the basis, what was the original cost, the date it was purchased, the date it was sold, whether it's short-term or long-term. All this will be accounted for. Not many of you will see this if you have a portfolio of investments. The reason being that if you do have a portfolio of investments, what are they going to give you, 100 of these 1099-Bs? No, the brokerage houses are allowed to give what's called a substitute 1099-B. And what that would do is the first column, let's say it says 1A, and you can see that on this 1099-B, which is a description of property. That column 1A will list that 100 types of securities, whether it's, General Motors, AT&T, et cetera, going on and on and on. Then the next column next to it will be 1B, date acquired, and it'll list it all the way from the top to the bottom, et cetera, et cetera. But that's what the form should look like. Now, a lot of forms have just come out of their draft for 2015, and I've got the latest ones in here. But there's one that they've already made the change and approved it for 2016. And the change is to box 2, where there's now 3 boxes instead of 2 boxes. First box being short-term, second being long-term, and the third being an ordinary loss. So this is what's going to be new for next year. Of course, you wouldn't see this till 2017, but they're done with this form, which is unusual, very unusual. So as I said, with new laws, we have new forms. So here's the form you should be aware of. And this is a form, instead of our continuation form, which was a D1 that went to the statement of gains and losses of capital assets to our personal returns and even on our company returns. We now have an 8949. There's some issues with this, though. Again, I don't know how many of you have ever heard of the Paperwork Reduction Act. Well, not when it comes to this form. You could actually have, depending on what you have, up to 3 separate forms. But the form is front and back. The front is short-term, the back is long-term. And there's 3 different types of transactions you could have. First, basis was reported to the IRS that you're covered. Or second, basis not reported to the IRS. It was before January 2011, so it's non-covered. Or C, the 1099 wasn't even received. So here's the form. And you see Part 1 is for short-term, and you have 3 boxes, A, B, and C. Well, if you had transactions, short-term, 3 separate types of short-term transactions, you'd have to have 3 forms. On the back of that form are the long-term transactions. Again, 3 different boxes on there. So now you may have 3 different forms for this.